Hi guys! Welcome to the Financial Pig. In this video, I'm going to be talking about perpetual preferred shares. Now, in my previous videos, I have shared with you the different types of risk profiles from conservative, moderate, and aggressive, and the different types of investments that correspond to them. Now, we have discussed that conservative investments include savings deposits and time deposits issued by the banks, and government securities like treasury bills, RTBs, and FXTNs. Under moderate investments, we have talked about the LTN CDs issued by the banks, corporate bonds that are issued by the corporations. And finally, we have come to the perpetual preferred shares. And these are under the moderate type of investment because, well, these are issued by corporations. These are not insured under any insurance, unlike the savings deposits and time deposits, which are covered by the PDIC, or the Philippine Depository Insurance Trust, Insurance Corporation. Well, perpetual preferred shares also are on the more risky side compared to the corporate bonds because they do not have a maturity date. And I'm going to explain more in this video. Now, I'm going to be talking about what preferred shares are, who offers them, how much you can earn, when you will get your money back, and in case, what will happen if you sell before the call date, and how do you open an account, how do you buy preferred shares. Now, preferred shares are actually issued by corporations. It's the same as the corporate bonds, but the difference is the bonds are, if you are in accounting or a management or business major, you're going to know that the bonds are actually listed under the liability section of the financial accounts, financial statements. Now, liability bonds, whereas preferred shares are under the equity side of the financial statements, which is, I think, if you remember, it's A plus L is equal to C, or assets plus liabilities is equal to capital. So that's a big difference between a corporate bond and a preferred share, but both of them are issued by corporations. Now, preferred shares are actually perpetual, which means that they do not have a maturity date, but they are callable. They have a callable date, which means that the issuing company or the issuing corporation is the one that is going to decide when they are going to redeem the shares. Now, the good thing about these is that they also have a fixed interest rate. They are similar in nature to corporate bonds, that they have interest rates, but I will show you more differences in the next slides. Who offers preferred shares? Of course, because they are shares, they are listed in the stock exchange, in the Philippine Stock Exchange. They are offered by stockbrokers, investment banks, brokerages, and again, corporations like corporate bonds, they also ask help from the stockbrokers and investment banks to offer their preferred shares to the investing public. Now, you can earn more than savings deposits, even more than corporate bonds sometimes, because preferred shares are considered more risky than corporate bonds. Corporate bonds, again, it has maturity date, but the preferred shares do not have a maturity date, only a callable date, where it's the company that will decide when they will redeem the shares and give you back your principal amount. Now, it also depends on how the interest rate environment is. So, and again, like the previous video I shared with you, it also depends on what the corporation is and their financials and what its rating is in the market. The riskier the company, the higher risk premium it's going to add on top of its interest. So to calculate interest income for preferred shares, interest income is equal to number of shares multiplied by the initial price, IPO price, multiplied by the dividend rate, multiplied by time. Now, let's say you are buying San Miguel preferred shares. There are a lot of San Miguel preferred shares actually in the market. They're from A to K as of this video. They have A, B, C, D, E, F, G up to K. So they have issued a lot of San Miguel preferred shares already. A lot of the shares were already redeemed by San Miguel. So now there are a few left. There are actually a lot more left, but they have already redeemed A, B, and D. Okay, so how do we compute? Let's just say you have 5,000 shares, and the price per share originally was issued at 100 pesos per share. So that means that your face value or your gross amount is 500,000. Multiply 5,000 shares times 100 per share. You get 500,000. Now let's say the coupon rate is 5% gross. Now I'm saying gross because individuals get taxed in the Philippines. They get taxed 10% withholding tax for individuals, whereas corporations, Philippine corporations, get 0% tax on if they invest in perpetual preferred shares. Now, the common peso preferred shares actually give out quarterly interest rates. And a side note is preferred shares can actually are actually allowed to not pay. If they can't do it, then it's okay for them not to pay a particular interest payment on a particular period, but it has to state whether it is cumulative or non-accumulative, which means that if it's cumulative, which is most of the shares are like this, if it's cumulative, it means that if they don't pay on this period, on the next period that they do pay, they're going to pay for the two already. Now, non-cumulative, which is very, very, very rare, non-cumulative means that if they don't pay a certain interest on a period, then the next interest period, if they're going to give out, they're not going to pay that previous interest where they did not pay. So just be careful of that. Okay, so for this sample, 500,000 times 5% multiplied by 1 minus 10% tax, that gives you 0.90. And you multiply it by 1 over 4 because the usual ones are quarterly interest paying. Now, if you multiply that using your calculator, it's going to give the answer of 22,500 pesos annual interest income. And if you divide it by 4, quarterly you will receive 5,625. Okay, again, taxation for individuals is 10% and for corporations is 0%. If you checked out my previous video about the corporate bonds, they get 20% tax on individuals and corporations. But you may be asking, why is it less in preferred shares? Now, it has something to do with the risk you are taking, okay? Corporate bonds are more safe compared to preferred shares. So it's probably an incentive by the government for you to invest in the preferred shares instead of the corporate bonds. Now, I have a lot of clients who are corporations who actually invest in preferred shares because they have 0% tax, which is, it makes the 5%, it's just 5%, right? Instead of deducting any taxes from it. So it's good. Now, this is actually more on the very nitty-gritty about buying preferred shares. We have buying fees, which is broker's fee, 0.25% of the gross amount or the principal. The VAT or the value-added tax on the broker's fee is 12% of the broker's fee. The SCCP or clearing fee is 0.01% of the gross amount. And lastly, the PSE transaction fee or the Philippine Stock Exchange transaction fee is 0.005% of the gross amount. So the sample that we have is, let's say, a gross amount of 500,000 pesos. You just merely plug in the details in our formula. excuse me, and you will get the total fees. If you buy a particular share and the gross amount is 500,000, your total buying fees will be 1,475. The total cash out is adding 500,000 plus the fees. It will get you have to pay 501,475. Now, selling fees, the only difference with selling fees is when you sell your shares, you have to add a sales tax. This is in red here. Sales tax, 0.5% of the gross amount. This makes it makes it bigger than earlier, right? So here's a sample. If your gross amount, let's just keep it uniform for it to be easy to understand. If your selling gross amount is 500,000 pesos, and you just plug in all of the details in the formula, and you add your sales tax, your total fees will be 3,975 pesos. And of course, the total proceeds that you will receive when you sell is less 500,000 pesos less the 3,975. You have to subtract the fees from your proceeds. So it gives you 496,025 net proceeds. And well, you can pause this video and really compute it using your calculator. Okay, so the question on when will you get your money back? When you invest in preferred shares, when can you get it back? Well, of course, if you sell in the secondary market, and you can actually sell anytime after when you buy a particular stock or preferred share, it's the settlement or the day that it becomes yours is T plus 3, which is today plus 3 banking or working days. So let's say you bought your preferred shares on Monday. Now you count 3 days, Tuesday, Wednesday, Thursday. So on Thursday, the stocks or the shares are already under your name. So then you can start selling those shares on Thursday or Friday or anytime after that. And number 2, if the company exercises their call option. So let's say you bought San Miguel preferred shares and you have been holding on to it for 3 years. And the company decides to say, hey, we can already exercise our call option. Let's redeem and let's pay back the clients their principal. So they can also do that. So again, if you sell the investment back to the market, which is the option number 1, you have to check out what are the market prices and check out what are your net proceeds so that you will not lose your principal. But that's already if you really need the funds, right? But then if the company exercises their call option, they will give you back the principal and they won't charge any fees from you. Again, it's best to allocate your savings ahead of time in case of emergencies. Now, I also shared this very important thing in my previous video, corporate bonds. If you sell before the maturity date and your preferred shares, their preferred shares dividend interest is 3%. And let's say the other investments in the market went down as low as 2%. That makes your preferred share more valuable than or more expensive than the other preferred shares. But you also have to factor in the corporation that is the issuer of this preferred share. Is it a relatively safe company or is it like a not so good company? So it's also a factor in the interest rate and the prices. And of course, if your preferred share is lower than the current market, let's say 3%, and now the market has gone up to 4%. So your preferred share, the value of it will go down and the price will be cheaper. There is an inverse or an opposite relationship of interest rates and prices. Now, how do you open an account? You go and call your universal bank or commercial bank near you, or you can open an online stock trading account. There are actually a lot of stockbrokers online where you can apply online now, and then they just have to interview you through Skype, and you have to send your IDs online through email. Now you have to inquire for preferred shares, and you can get them from IPOs, initial public offering. This is completely new. You don't have to pay any broker fees or buying fees. Or you can buy it in the secondary market where someone has already bought it and sold it to someone else, who is you. But you have to pay for the buyer's fees now. To open a stock trading account, you would need to have, of course, a bank account, 2 government valid IDs, a TIN number, BIR TIN number, and other personal details that they will be asking you. And they usually really have documentation for this because it's very important when they get audited. And your confirmation that you bought those stocks will come in the form of email, or actually, depending on the bank that is offering the shares or where you bought it from, they will give you a confirmation. But in the past, probably in the 1990s or earlier, they used to give stock certificates, bonds, stock bond certificates. Well, now they have made it into scriptless securities, which means that scriptless means they no longer give you any paper and everything is online. So don't expect a confirmation which is in paper. They will usually ask for your email address so they can email you confirmation. I think the reason also why they do this is to save on paper, because a lot of people actually trade every day and they might be confused with all the papers that they're getting. So just again, comment any questions and I'll try my best to help you and answer the questions. Have a great day. Hi guys, welcome to the Financial Pyramid.